Hey, welcome back for another episode of our podcast, Connecting the Dollars. Today, we're going to discuss the pending federal rate cut, which we anticipate on September 18th. We're going to discuss moves we think people should make with their cash, how this could impact the bond and stock markets, and potentially even the mortgage market. So let's get into it. Today, Emily is off, but I'm joined by my fellow advisor, David. Welcome. Thanks for
It's
joining
good to
us
be here,
today.
Amanda.
Yeah. So I know you love talking about the Fed, so it's a great topic for you. So like I mentioned at the beginning, we anticipate the Fed to cut rates next week at their September meeting. We are recording this about a week before that announcement, so it hasn't actually happened yet, but pretty much consensus is there will be a rate cut, and there's betting markets are I think mostly settled on a 0.25% cut, although there is a possibility of a half a percent cut out there. We'll see which way they go, how much they want to cut. Um, and so earlier this week, we sent out some communications to our clients suggesting that you wanted to evaluate if you have cash on the sidelines. Now would be a great time, could be a great time to put that into bonds, corporate bonds, treasury bonds, maybe a CD to lock in the rate while it's up before the Fed um, cuts rates. What do you think about that, David? Do you think have you seen a lot of clients doing this? I mean, we've been talking to clients about this for months now to get this done before they cut rates. So we're sort of at the end of this high rate period that we've been enjoying.
I think it's a good idea, and I think it's also a good idea to have some of your portfolio in bonds. There was a long period of time where bond rates were so low, it almost, like our clients were saying, why would I buy these bonds that pay 1% interest or less? But now that they're paying something, they're more useful. So, we've been talking to people about adding bonds to their portfolios in keeping with their risk tolerance. It varies by person how much they might want or need. And now, initially those rates were very high in the short maturities, so it made sense to stay quite short and get those high rates because the Fed had raised rates a great deal. Now, as it brings them down, it's going to make sense, and it does make sense to extend those maturities a little bit if you don't need the money right away.
Yeah. And I mean, they are coming down, but right, I just said we don't know if it will be a quarter of a point or half of a percentage point, but those still are good rates, even if, it's 4.5%. That's nothing to shake your fist at. Um, on the treasuries. I think a question I get a lot from clients is why not just stay in a money market? Why not just stay in a high yield savings account if the rates are that good? Um, I usually say you can still lock in this rate for longer, especially if the Fed continues to cut rates. And then there are some tax advantages to buying treasury bonds directly instead of going through a bank. But that depends on an individual situation, how much of an impact the tax question is.
Or the other part of that is, I think you mentioned it a little bit, is that the Fed's not just going to do this one time and quit. You know,
Right.
they're already talking about how many rate cuts they're going to do before the end of the calendar year. And there's a lot of talk about, and what are they going down to? And they talk about a thing called the natural rate, where the rate doesn't have a restraining effect on the economy and it doesn't have a stimulative effect on the economy. Right now, it's pretty clear that the rate that they're at in federal funds is holding back the economy. They did that on purpose to get inflation down. But now that inflation has come down, there's a very good argument that they're going to keep moving rates down to try to find that neutral rate, really is what to call it, I think, where
Yeah.
they're not restraining the economy and they're not trying to overly stimulate the economy. So that means that if you're in short-term money markets or adjustable rate treasuries, we've got clients with some of those too. Those are going to drop and they're going to keep dropping. Whereas you can lock in a rate out there, we're doing mostly an intermediate areas, in 2, 3, 4, 5 year bonds, depending on when you might need the cash. And locking those in is going to be productive for people, we think.
Hmm. Yeah, and I think when we talk about 25 quarter of a percentage point, half a percentage point, those sound like small numbers and they are small numbers, but once you convert them to dollars, these are become significant numbers and can have a big impact on a person's investment portfolio. Um, so we think that's an important thing to look at. If you don't know if you have excess cash, you can take some time, look at your budget. Right, we want an emergency savings account of 3 to 6 months, depending. And then funds beyond that are typically what we consider excess cash. So, one other question we wanted to get into is we're also hearing from clients is how is this rate cut going to impact the stock market? A lot of people, have a lot of money in the stock market, not just in the bond market. Um, and historically, it's been a mixed effect, right? The Fed cuts rates, the stock market goes down. The Fed cuts rate, the stock market goes up. And so we don't know exactly what's going to happen. Typically, it's more a factor of why the Fed is cutting rates. If they're cutting because the economy is getting worse, you could see the stock market go down. If they're cutting like they are now and the economy is still okay, we might not see an impact or the market might go up. Um, I think that's a much more complicated question than the impact on the bond market.
That's true. And that context that you're talking about whether it goes up or down depends really on the context. We're in a bull market that's been in the stock market that's been going on a couple of years. Is that going to continue? Is that about to run its course and go into correction? We never know those precisely. But when earnings look like they're going up and the economy looks like it's making it through this soft landing where it's not where the tight interest rate policy of the Fed has not caused a recession, those are pretty positive possibilities. So I tend to think we're going to see a continuation of the rally with some volatility. There'll be some ups and downs, and those will cause people some concern. But it is a more
Hmm.
complicated question, and it may change depending on what happens with the unemployment rate. If the unemployment rate keeps working up, that's the second part of the Fed's mandate. Their mandate is to have a stable uh, currency and monetary policy and interest rates. But the other part of the mandate is to have a stable labor force that does not leave a lot of people unemployed or more than the economy ought to really have as unemployed. So those other factors are going to affect it too in a big way.
Yeah, yeah. I know people like to say soft landing. I'm thinking of it as a bumpy landing. Like
Yep.
we're gonna come in, it will probably be okay, but there's gonna be some bumps along the way. Think th- with the COVID and the aftershocks of COVID, is a lot of unprecedented things happening in the economy, and all the experts make their predictions, but a lot of they just don't know because this is not a situation we've really seen before. So, um, what can you do? I think mostly
Well,
it's going to be
what
okay at the end of the day, right? Like long-term optimism, short-term, okay, there might be some bumps, but it will turn out okay. That's sort of how I think about it.
and that's why we often tell clients to, put a foot in both barrels, so to speak.
Right.
And you've got some bonds to diversify. They're going to provide some safety for you. The stock market roars up, the market's going to do a lot better than the bonds. But if the stock market is bumpy or goes down, those bonds are going to do better than stocks. That's, usually true for short periods of time. But the one I remember was back about the time of the dot-com bubble. And in the aftermath of the dot-com bubble, bonds outperformed the stock market for 3 straight years in a row. And that had not happened since the 1920s. So usually we see, relative performance favoring the stock market. But in terms of moderating volatility and also making sure you have the cash you may need in a, the foreseeable future, whether it's to buy a new car or have a down payment on a house or start a business or pay for kids' college, bonds are very useful based on those time targets that are in your own financial plan.
And then another topic we wanted to touch on was the Fed is talking about cutting rates, but the Fed also does what's called quantitative tightening, which has been their policy the last several years. Do you want to give our listeners a quick explanation of quantitative tightening that the Fed has been doing? I know it can get a little bit jargony. I don't think a lot of people follow this, but maybe do your best.
Well, interest rates are more than just the Fed funds rate. That's the rate on very short-term money. That's mainly what we've been talking about here. The Fed's expected to cut rates on the federal funds rate. That's short-term rates. Those are the rates on that banks pay to each other, overnight or for very short periods of time. Um, those interest rates that people are also usually concerned about are mortgage rates, and they tend to be out further in the maturity structure. They tend to follow the 10-year treasury more than the short-term rate. And mortgage rates were quite low in recent history. One of the reasons they were is the Fed pursued a policy of what they call quantitative easing. They bought so many mortgage securities, they kept that rate low. They called that a quantitative easing policy. But they were buying mortgage-backed securities. Their own balance sheet got huge, higher than it had ever been, $8.9 trillion at its peak in 2022. And the Fed says, well, this is not normal. We can't keep this balance sheet this huge. It's probably one of the reasons we had some inflationary pressures in the first place. We need to work that down. And so as they begin to do that, they begin to sell off those mortgage-backed securities, and they shifted from quantitative easing, that's kind of the gobbledygook word you're talking about, Amanda, to
Hmm.
quantitative tightening. That just means they're letting those mortgages mature or run off without reinvesting in them. And that has caused their balance sheet to come down by a couple trillion dollars. These are amazing numbers. But the U.S. economy is a big thing, and the Federal Reserve is a big thing. So they do go into big numbers. They got worried about it as they began to see inflation come under control. And in just in May, they shifted their rate of quantitative tightening, the selling off of these mortgages that had accumulated in their balance sheet, to slow it down because it began to complicate banking reserves and other things. And now we're kind of at another one of those watersheds. As they reduce the federal funds rate, right? Are they going to further reduce a quantitative the sell-off of mortgage-backed securities?
I don't think they haven't made it a statement if they're going to that
No, it
I
may
know
come
of,
as a
right?
surprise, I think, if
Yeah.
they do.
So yeah, I think a lot of that, the plumbing of how our financial system works is I wish it was easier for everybody to understand because it's important and impacts your home you buy if you want to get a mortgage. I mean, that's a direct impact on your, daily life, but it's a little bit complicated and
Yeah.
out there.
Historically, I
So
don't know if the country stumbled into this, or just made rational decisions that worked. But, the Federal Reserve System is not the U.S. government, you know. It's really
no,
a partnership between the government and private banks, the private sector. And so these bodies that meet, the Board of Governors of the Federal Reserve System and the Open Markets Committee, they have private sector bankers on them, that are selected through the banking system,
right.
and then they have people appointed by the president, who are appointed by the in the political system and the governmental system through the president's appointment. And so it's a hybrid system. It's worked pretty well, but I think having those two groups and some experts that have I mean, everybody's afraid of PhD economists. They think they're just, they sound so gobbledygooky. Nobody quite knows what they're talking about.
Yeah,
But they've done a
yeah,
pretty good job, I think, in the long scheme of things, and it's partially because of that partnership between the government and the private sector that's institutionalized in the Fed.
yeah. Um, I know we're coming up on time, but I was recently in London with my family on a vacation, and we did a tour of the Greenwich Maritime Museum, right? So a lot of English history is maritime history, right? Um, and so they told the story about when Elizabeth the First was the queen, and the country was in incredible debt based on all the wars that had been going on. And Sir Francis Drake went out in his ship and attacked a Spanish ship and took all their gold bullion and then brought it back and delivered it to Queen Elizabeth. And they said, "Oh, now our debt's wiped out. You're great." That's just like how they solved their fiscal crisis. Just went and robbed the Spanish. That was a pretty simple way to do it. But it's not
And we
like
think
that
printing
anymore.
money, the Fed printing money, which it does,
Yeah. Oh,
right?
maybe it's like the Fed printing
Yeah,
money
I mean,
is
would you
robbing
rather
these
print money or
Spanish
send out ships to
slave
steal other
ships.
people's gold? I mean,
Yeah, I
the
mean,
history
yeah,
of how, and gold was the monetary system back then, and silver to
yeah,
some extent.
yeah,
And how we do that and how it's evolved into this Federal Reserve System where we print money and have these groups of economists and people get together and make these decisions that everybody, kind of holds their breath till they hear how it's going to come out. Um, it's way
yeah.
different than
Hmm.
fighting ships to steal people's gold.
Yeah, now we can have political debt ceiling. Doesn't, I mean, so many
Oh, yes.
people don't even know what that's about?
Yeah.
Anyway, go off. But well, so thanks for coming on, David. Emily will be back soon. And if you have any questions on this, please leave comments for us or let us know. Um, until next time.
Thank you, Amanda. I get to enjoy my Fed fix today. I appreciate that.
Yeah.